Looks like we're pulling off those highs, but that'll be an interesting thing to talk about. All right. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacity licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, on we go. So now I can share my desktop, apparently. Share my desktop. And we're off. All right. We are looking at the WebEx screen. Let's look at the S&P first. Well, let's see if I can bring it. No, I don't know if I can do that. So we're at basically 2,000 on the S&P. Oh, I don't have my finger swim up. Okay, can you guys see my thinkorswim screen now? Okay, great, good. All right, we're all set then. Okay, sorry about that. Let me get this set up properly. There we go. All right, so this has been a very interesting sort of test of the 5% rule. And in chat, we were talking about this earlier. Let's see if I can pull this window out. Okay, I'll pull that one out. And do that. Drop those down. All right, so let's see if we can make some sense of this for you guys. In today's chat, just a few minutes ago, I made some charts. And what we were trying to accomplish was sort of show what was supposed to happen by the 5% rule. So here we go. So here is, that's not the Dow. Here's this, okay. So here's the Dow. All right, and here's the longer view. This is a 10-day chart of the Dow. So we came down from 18,000. You see we tested 18,000, failed. All right, and there's different ways to look at the 5% rule, but you have to always look at your larger lines. And in the Dow, 18,000 is a very significant large line. It's 50% up from 12,000, and 12,000 was 100% off 6,000, which is where it bottomed back in the crash. And 12,000 was a good consolidation point, so it proved itself. This is over the very long run. So we're using these lines, and that means 18,000. It's a 50% line for a move from the Dow from its midpoint. And obviously, eventually, we expect to get to 24,000, but that's a long way off. I mean, it's over years, so we're not worried about that now. 18,000, though, is a definite testing area that we expected a strong retracement from. So, this line is going to go here regardless of how well you think it touched it. If I was going to draw a consolidation line, I'd probably use 17.9 for a short term, and I use 17, 150, 175 here. But you know what? These bounces, since you're working off a smaller range, if you did that, you'd be like a 750 range. So at 750, you'd have a 150-point bounce to 17.3. And it really works out, see where the bounce line is, 17.3 anyway, 17.280. It really works out almost exactly the same. So interestingly enough, when you squeeze it down and you try to go consolidation to consolidation, even if you try to play closer within the range, you're still going to end up with the same thing. And that's why one of the things you got to learn how to do with the 5% rule, if you want to chart it, is learn to just throw out these spikes. You ignore them. Anything that's like this, a spike, doesn't mean anything. What matters is where the bodies of the candles form and where you see a consolidation pattern. So along this line, 17.9, there's consolidation, but since 17.8 is a major line, we're using that one to make our drawing. So 17.8 to 17.1. Now, why 17.1? Because you take 95%. It's very simple. Watch. Get a calculator. All right. So given that we know 18,000 is a serious line, we take 18,000 times 0.95 and 17.1. There you go. That's where that line comes from. It's very simple. So I expect to see 17.1. So when I do see 17.1, I'm extremely pleased because it means that the 5% rule is holding up well. Also, though, when you see such a strong bounce, a quick rejection of the 17.1, like it barely gets there and gets banged up right away, that kind of indicates on the Dow at least that it really is kind of bouncy here, and that means you're going to expect at least a weak bounce. And how much is a weak bounce? A weak bounce is a 20% retrace of the drop. The drop's 900, so the retrace is 180. And where's that line? 17,280. Isn't that? It's like magic, right? And there's the 17,280 line. Look how that worked. Even on the way down, that line came into play. Because the point of the 5% rule is the computer knows where it's going, and the computer knows where it's going to retrace to. So the computer knows the support line here. This is a controlled sell-off done by a machine. And the machine knows it's going for here, and it knows it's going to start buying here. And this is a point at which some other computer programs, since other computer programs know the same thing generally, some of them start kicking in and buying on the way down here. So the ones that weren't selling start buying because they want to push it up for whatever reason. And they'll buy here, and they'll buy here, and they'll buy here, and their average is going to be here. And by here, and that's the point. So then when it bounces to here, the machines that bought with an average price around here begin selling. Because they're like the, what's the word? They're the high-frequency trading kind of things. Not really high-frequency, but like day trading houses and things like that. They only want to make 2 or 3% or 1%. They're thrilled to make a half a point. Okay, they're making quick trades. They see the thing go down. They calculate where the bounce should be, just like we're doing, and they start buying at the bounce point. And if they're wrong, they dollar cost average down. But they just like we do, they feel strongly that 17.1 will be support. So when we get to 17.1, there's a buying frenzy that tests immediately a half a week bounce. That's what this is. This is half of the week bounce. At 175 would be about 1/2 the week bounce. So at that point, they immediately get into a buying frenzy because they expect this move. Then at this move, though, a lot of those guys dump out because they're just happy to make that little 150 points. 150 points for them is great. That's 1% on the Dow. They're thrilled to get out. So that's why these lines occur. It's because of the way the programs conflict with each other. They're buying programs, they're selling programs, and so on and so forth. But when you think about how many thousands of different programs are running at the same time, they tend to cross at certain predictable points. And that's because of the nature of the way these programs are written and the way that the algorithms are written and so on and so forth. And I think a lot of you might know that my dad and I used to write some of the early programs that did this sort of thing. So, you know, this is what I observed when we were writing these programs. We would sit down with people from the investment houses, and they'd say, oh, we wanted to do this, and we wanted to do that. And after meeting with a bunch of them, I started realizing they all want the same thing. They go about it a different way, but they want the same thing. They all are generally using the same computer programs written by a very small group of guys who would do this kind of work. And yes, they've evolved over time, and they're much different now, but they're not really that different. It's still the same concept. It's still these programs written by committees over time with groupthink put in, and this is what happens. They end up converging these points. So where am I? Oh, yeah. So that's how we can calculate these bounces. And you see how well it works, though, because I said this in the morning. I said what was going to happen. I said we're going to go down a half a point at the open, and we're going to turn around and bounce up a half a point. So this is plus 0.5%. And the most we're going to bounce is plus 1%, which will take us out to around here, 17.5. And it's just a predictable machine move that we know is going to happen. And you see what happened here? We got to this point. This is different than the Dow, of course. The Dow doesn't look the same as the futures. But you see how we just got to this point, which is up just about 1% or so. And now we failed. And now we're only up half a point. So it's turning into a weak bounce, not a strong bounce. This is not at all impressive what's happening here. We bottomed out here. We came up all the way up to here, 17,379. So we came up from 974 to 379, 400-point move, and we just lost half of it. 400 points with a 17,000 Dow, 400 points is a strong bounce. Okay, so we have a 900-point drop, and that means 900. You've got a 180 plus 180. So how much is 180 plus 180? It's 360. A strong bounce is 360. This basically, especially if you ignore the spike and go off the 17 line, so 17,000 plus 360, because 180 is a weak bounce. Okay, so 17,180, that's a weak bounce line, and 360 is a strong bounce line. Look at that. See that? 17,360. We predicted that before it fell. We predicted that last Thursday, in fact. Way back here, these are the lines that we predicted when I wrote that post last Thursday morning. Let's see. So when the market looked like this, we were able to say that we were going to fall to 17.1 from 17.7 last Thursday. I wrote in the morning post that we would fall to 17.1, and from 17.1 we would bounce to 17,360, which is a strong bounce. From 17. Let me say. So from 17 to 17,360 is a strong bounce. It's just math. It really is. It's just math. It's the simplest thing to calculate. And that's why, when I used to do the 5% rule, I used to do it on a spreadsheet. I didn't use a chart. I only started using charts because I would interact with people on PhilStockWorld, and it turns out that people like to see charts. But for me, this is all just like numbers dancing in my head. Like, I only think of it as like a mathematical equation. I never really, I frankly didn't look at the charts. I mean, I did not have any interest in charts when I used to do this. But as I kept talking about the 5% rule, people just can't get their heads around it without the charts, so I started doing charts for it. And Jean-Luc has been fantastic doing that also, like helping us put charts up. Where are we? So, and now I figured out on stock charts, I figured out how to do these cool things. So this is nice. So it only takes me about 5 minutes apiece to illustrate these, so it's kind of cool. So there's the Dow, very easy. Okay, now we look at the S&P. Same story, right? And where is that S&P thing? And here's your S&P. So, you know, look, what are we predicting? We're up, this is 2090, so we go from 2090 to 1980 is, I don't even know that number. Why is that so confusing? 20, okay, 100 and, thank you, 110 points. So it's going to be, so the bounce is going to be 22 and 44. So 45 plus 1980 is 2025, right? Is that right? Yeah, 45. Yeah, so 2025 is actually the strong bounce line. We didn't hit that, though. What we hit was this line here. See, 2010, we're going to go halfway up there. You see how that came right to 2010? So from 19, well, here's 1970. That's also, the futures don't line up with the charts, don't forget. So here on the futures, I go from 1970, and how much is 45 points? You know, it's the same 45 points, though. So how much is 45 points plus 1970? 2015, right here. That's what's predicted, and that's what actually happened. So this was a strong bounce. We rejected the strong bounce and comes here. And by the way, rejected the strong bounce at 11:30, okay? So what did I say at, what time did I say it? I forget. Oops. I could have sworn I said to take off those things. Maybe I'm wrong. Anyway, so oh, there it is. I knew I said it. So here at whatever time I did these charts, 11:42. So in other words, I'm watching this while I'm making these charts, and at 11:42, I see it's clearly being rejected. So I put up my post, and we're doing our charts. And the last thing I said when I'm just about to publish on the post, I took a look at the charts, and I said, certainly a good time to take off profits from those future contracts. Can't be too greedy. That was a great run. And that's what you do. You know, we expected this bounce. We called the bounce over here. We watched it go up and up and up. It was a jagged run, but it kept making progress, so it was fine. But then we got this big blow-off move up, and then it started reversing. So we get the hell out and take the profits. It's so simple. That's big money on the S&P. You're looking at a 70 to 05 is what, 25, no, 35. 35 points times 50 bucks is what, 1,500 whatever dollars. That's a $1,500 move. That is so easy to call, and we predicted it last week. All we have to do is wait for it to happen. All right, Wayne says, how can you narrow down understanding of the bid-ask spread other than taking the midpoint when the options are not traded much and the spreads are several dollars apart? An example would be BHI, 57, 50, bull call spread. Each leg has a huge bid-ask, but I don't have an understanding of how to determine a fair price offer on the spread. Well, generally, well, first of all, there's observation. All right, so in other words, if we go to BHI, BHI. All right, and you were talking about the 2017, right? 57.50, which was our thing. So your 57.50 has a ridiculous bid-ask spread of 730 and 11. Okay, we go over to the active trader, and we'll put that in. So you just copy the number into active trader, and you can see it on this chart. Maybe. There it is. Okay. So this is a 5-minute chart, and we're looking at, it hasn't been, nobody's bought it since Thursday, but here on Wednesday, it was 988, and it was 940, and it was 850. So here I can see that there have been people buying them between $9 and 988. So now it's easy. I can say 950 is a fair price to that, right? Now, had I just eyeballed it, I would have come up with the same price, right? Because what's in between 730 and 11? 9 something, right? 950. So it is the center price. $9 was there, but the center of the bid and ask is where the real value is. So I mean, whenever I'm quoting these things, I just look at the bid ask and I say, okay, look, I'll call that 950, and I'll call this one the 70s using the same logic. I would call that about $4, and that means the spread price is $5.50, and I wouldn't pay more. And in fact, if I'm going to offer, see the same thing. See how it comes in $4.29? It comes in dead center between the two. That's where these things price out. So you have to realize that it's an auction, and people want to sell you these things. Like, these options are being auctioned, and you're a bidder. You're going to offer to buy one, you're going to offer to sell one, but either way, you're a participant in the auction. And as such, it's up to you to set a price. In other words, if I'm auctioning off, let's stick to Levi's because it's the easiest thing. If I'm auctioning off a pair of Levi's, I know the Levi's are $40. Okay? I know they're $40. I know what they're worth. So now, if I want to get rid of them, I'll take 35, maybe I'll take 30, but I'm sure it's not going to take 25. I don't care. If somebody only offers me 25, I'm going to say, screw you, I'll go sell them somewhere else, because I know I can get 30 somewhere. And if I'm buying them, if I'm desperate to buy them, I might pay 45, but I'm not going to pay 50, because I know I can find them for 40. I just have to look a little longer. You're looking at a 2017 spread. You've got 2 years on this trade. You're in no hurry whatsoever to fill this trade. So what you should do is you should say, okay, if this one's $9.50, if these 57.50s and $9.50, I'll offer 9. And if these guys are $4.25, I'll ask for 5. I'll offer to sell them. No, you're selling those, so I'd offer to sell them for 5. And the thing is, you have to realize that you're betting the opposite thing. When you're offering $9 for the 57.50s, that bid will come in if it's going down, right? So BHI is going down, and you'll get your price. On the other ones, if you're asking for 5, someone will fill that. If BHI is going up, then the price of those will go up, the ones you're selling. So in other words, all you have to do is put the 2 bids in at prices you want and wait for one of them to fill. One of them will fill. At some point, BHI will go up and BHI will go down. One of them will fill. Probably both of them will fill if you're patient enough. And then the trick is to say, when one fills, then you have to look at it and say, okay, now I got to get a little more serious about taking something on the other side. But if you get yourself a good fill on one of your legs to start with, then it's much easier to get a reasonable price on the other leg. You're back in control. All right, so that's one thing. Also, another trick when you're filling these orders is you don't have to fill the whole order at once. If you're trying to get 10, you can just ask for 2 on each side first, and then when you get your 2 at a good price, then you can ask for 2 more at a good price. You know, you can get 2 and 2 and 2 and 2 because you've got 2 years. And if it gets away from you, which is doubtful because there's always going to be something, like I said, one gets cheaper and one gets more expensive. If it gets away from you, then all that's going to happen to you is that, if it gets cheaper, if it gets away from you, like it shoots up, it shoots down, whatever it doesn't matter because you have X amount at a good price that you filled, and now you wait and see, and maybe you're going to roll, and maybe you're going to adjust, or maybe something else. So don't get fixated on trying to fill something. It's not an emergency. It doesn't even matter if you never get the trade. There'll be 1,000 more trades to have over your life. This is, you know, and by the way, I'm going on TV tomorrow. I'm going to tell people that Baker Hughes, this trade is my trade of the year. So it'll get a lot harder. It'll get harder or easier to fill. I'm not sure. There'll be a lot of activity on it starting tomorrow, though. So tomorrow night I'm doing a TV show. So, you know, this is a fantastic trade. And it's just a matter of getting a fill at the right price. But the fill is going to be determined by the movement of the stock over time. And even if it changes, if you leg into it carefully, you'll get a good price. And it's really a matter of practice. You got to practice doing it. You know, it's almost like saying, well, how do I hit a curveball? It's like, well, you know, I can tell you how to hit a curveball, but you're going to have to swing at a bunch of curveballs until you get the idea. And a lot of it is getting the feel of it, right? It's learning when to take that swing and when to watch that pitch. And you got to get your timing right. You've got to learn these things by doing it. You know, I wish there was a way to hold your hand through the entire process and tediously go after every single thing, but there's not. You just have to start practicing. But please start practicing by getting yourself a good price. Don't practice by getting bad prices. If you don't get the trade, then you don't bill it. So what? Okay, there'll be other trades. All right, so what happened here? All right, so that was Wayne. Now, Craig says, not sure if anyone cares, but CNBC is the monopoly trial. Well, I don't know what happened there, but it doesn't matter. It's the whole thing. It's like $1 billion, $2 billion, $3 billion. If they really whack Apple, it's going to be a few $1 billion fine. So they'll have to take a few days worth of money and throw it in there. It's not even a thing. Don't forget Apple's got $200 billion sitting in a bank. So it's a non-issue. It's just it doesn't affect their current system. It doesn't make them change anything they're doing now. It's just past sins of the company, and it's really just a nothing fine. But it is spooking people out of Apple somewhat, which is interesting. It's Apple's down at 107.84, so at least it's a decent price. Not low enough for us to want to do anything about it. We'd like to see it below 105, frankly, so we can sell some puts. But it's at least it's a little spooking Apple, and we'll see how it goes. CBOA has a good option pricing tool, allows you to use any option with your own variables. Okay, well, I've never seen that one. Okay, now who's saying this? Hang on. Larry says, if Hal offers 1.12 shares plus $19 and Hal's at 40, that's only 59. And why the spread you identified? Because Hal got beaten up, and Hal's going to have to up their offer. When we did it, at the time we did it, that was the spread that made the most sense because the offer netted 75. You're right, though. This time, it is really only 59 because Hal went down tremendously, which means that but that's a good point, actually. So that's a new spread. I wouldn't go there. I would probably want to go, let's see, what can we get here? The 40s, that'd be interesting. 40s, if these are 20, that's 2020. So let's say if you get these at 20, and you sell these for 55. So we sell the 55, so you're not going to get 12.85. That's a nonsense number. So let's say $10 here. And what I say here, 20? No. Yeah, the 40s. Okay, so 20 and 10. So that's no good. That's $10 on the $15 spread. I wouldn't do that. So now let's look at the 45s. The 45s are, I would say 16 something. Let's see, 15, 20 is too far away. So 16, let's say 16. So 16 here, and then the 60s are 750. So 750 and 16 is what? 950. No, I don't like that one too much either. And then we're back. Well, no, it's still actually not bad. So then we're into the 50s. The 50s are 1290. I'll take that one. That seems about right. So let's call that 13. And the 65s are 6. All right, $7 there. That's where I go. The 50-65s is the one I would take now. All right, so there you go. So the 50-65 bull call spread for, I forget the price already. What did we say it was? 13 minus 6. So for $7, there you go. That's a good spread because you're getting more than 100% back if it hits your goal. So I like now, instead of the spread we did before, I would prefer the 50-65 bull call spread. And we can sell these guys for $6.50, the 50 puts for $6.50, and now it's net 50 cents on the $15 spread. So yeah, you're right. I mean, we would modify it because the price has changed since we did that spread. Not that I don't like the original spread, it's fine, but actually if we had it, and I think we do have it in one of our portfolios, we can roll it down to a lower strike now. Well, I'd be on BNN. Yes, Chrissy, I will be on BNN. What's the official BHI trade? Well, at this moment, the official BHI trade is now going to be the 50-65 bull call spread selling the $50 puts. Apple won the trial. Oh, that's bullshit. Oh, that is terrible. Oh, my God. I'm sorry. Corporations just own this country. That is ridiculous. They are so guilty. If you have a profit on the sale of the 70 call, do you take a profit on that leg or let it run on BHI? Well, I mean, if you sold the 70 call in conjunction with the other thing, if your profit, you still got, what do you have? Well, let's say it's 450, right? So maybe you sold it for like $6 or $7. So if you made 250 fast, you could take the profit. And frankly, I wouldn't not have anything short. So the only reason I would take the profit is because I intend to sell something else to cover, and then maybe roll down my spread a little bit or something like that. But we already determined it's really not going to go for more than 75 at best. So even if Hal ups their offer a little bit and sweetens it somewhat with some more cash, which is most likely what's going to happen. So Hal will probably up the cash portion like $25 or something like that. Even if they do that, you're still going to be in like the 70 range. You're probably not going to make 75. So what are you going to do? I mean, why would I pay $4? No, why would you pay $4 now in order to maybe get up to 75 instead of getting cut off at 70? It doesn't make any sense, right? You're not saving yourself enough money to take that risk of $4 extra. So, I know it's always fun to take profits and it's tempting, but you have to have a really good reason. Yeah, you can say, yeah, I mean, it turns it into a risky play. So now you're gambling. So with your intention to gamble with this trade. See, now for me, one of the issues I would have with that, from my point of view, is I would have a trade like this in my long-term portfolio, and it's not a portfolio I look at every day. So I don't want to be gambling in that portfolio. I like my head to be in one place or the other. So when I'm looking at my short-term portfolio, I'm looking at every single trade and thinking, should I adjust this right now? Should I adjust this right now? Should I adjust it right now? When I look at the long-term portfolio, I'm really not even looking at it. I just kind of glance over it and see if anything's drastically bad. But as long as nothing's drastically bad, I'm not going to touch it. So for me, as it's a long-term trade, I've got no interest in running short-term strategies on it or playing for bounces. Logically, though, yeah, you can do that. You can day trade it, but you've got to be comfortable saying you are the kind of guy that can make more money day trading this stock than you're going to make just letting it sit. Whereas for myself personally, for my trading style, I'm more comfortable letting it sit, knowing I've got that $4 coming to me one way or the other. And if I want to trade BHI as a day trade or Halliburton as a day trade, I'll make a different trade in my short-term portfolio on it. So that's my attitude about it. But it's always a personal preference. There's no right and wrong to it. It's a matter of what kind of trader you are. But I like to have a small group in my short-term portfolio and my larger holdings in the long-term portfolio that I don't look at very much. It's not something I have to worry about, so I can focus on the stuff that is active. Did we close the FXI trade? I don't know. Did we close the FXI trade? Where is that FXI trade? I don't know. I don't remember where that is or if we officially had it in the portfolio. Chrissy says, when I look on Thinkorswim and look at January 15 DXD bull call spread, the 23 call shows a loss, but it's 23.48. Shouldn't it show a gain? Yeah, these things tell you stupid stuff sometimes, so don't worry about it. We just got out of our DXDs. I hope you realize that we took the money off the table on those DXDs this afternoon, or this morning actually, because we took that big drop in them down and said, hey, let's take this off the table. So you're looking at the January 15 DXD 23s. Well, that's a wide spread. See, again, you're looking at the 75 probably. There's no 75. That's bullshit. How can it be 75 when it's a 23.44 and you got 30 days to go? That's nonsense, and you know it is. Okay, it's only the last person paid about. Look at the one below it. Wait, you said the 23, right? The 21s. I'm sorry. The 22s are $1.50. That's a big gap. That's it, and that's only because these have just been transacted more recently. This one hasn't had a recent transaction. The reality is somewhere between 80 and 120, so it's right about $1 would be the correct price for these. And whether that's a loss or not, I don't know. But the point is, it really should be $1. Also, the 27s, by nature, the 27s obviously are completely worthless, yet they're hanging on to what's imputed as a 30-cent value. So that's nonsense too. But the reality is, look, the reality is you got a spread that's worth 42 cents. That's how much that spread is worth. It's 42 cents in the money. At the moment, it's worth 42 cents. Okay, you need a serious move in DXD to make any money. It's hard to say if that's a good thing or a bad thing. Frankly, it's just, if it's a hedge, it's fine, but it's certainly not going to make you money. It won't make you money unless the Dow goes down and stays down and goes considerably lower than it is now. And Zhao says the problem with that is the puts and calls gain 60 to 70% in the market hand. You goose egg, and then you have to go rolling around. It makes sense. I'm not even sure. It doesn't make sense. I'm not sure what the hell you're talking about, Zhao. The problem with that is the puts or calls gain 60 to 70%. I need you to actually specify what the heck you're talking about. BHI. Oh. Okay, yeah. Do not make these plays if you were going to sit there and stare at your portfolio values all the time, because they're going to mislead you. So if there's no 60 or 70% anything, you're on track or off track for your 2017 position. And yes, sometimes it's going to tell you really stupid stuff. We had, for a month almost, we've had this stupid SQQQs that was showing us a ridiculously undervalued price in the short-term portfolio. Finally today, they popped up to 680. But days ago, they were like $3, or showing us under $3. And we knew they were worth more than $3. And it's not just because the NASDAQ changed, but it was giving us a ridiculously low price because nobody did, it's thinly transacted. We didn't get rid of it. We couldn't add to it because it wasn't a real price, but we didn't get rid of it. And you see there at 620 was the last transaction, but early we got up for a nice price. Copy. How's that work? Oh, there it's copy. Okay. So you see, we got up to 680, we had 670 and 675. We called out of this thing early, first thing in the morning, because we finally got a good price. And we said, let's get the hell out of this stupid thing. So we went down. We didn't get completely out of it. We went down to 50. We went from 100 to 50. So we sold the naked 50 that we had. We got out of them because we had a nice dip of the NASDAQ. We were happy to take the money off the table. That was back here in the morning. See over here when it was down, way down here. So we had this nice little section over here where we were getting our prices, and we got the hell out. That's us getting out, in fact, this big spike. So good job, guys. And again, it's important you understand. You can't just play the stuff blindly, and you sure as hell have to be smarter than your broker account. You have to understand the options and understand the prices. And go back on the seminars for the last 3 weeks. I've been talking about those SQQQs. Every time we look at them, I'm like, well, that's nonsense. That's what I keep saying about it. It's nonsense. Our short-term portfolio is fluctuating up and down $20,000 because we had 100 of these SQQQs, and they were showing us ridiculously low prices for no good reason. See, it's 464. See, the actual transactions are in the $4 range, but the brokerage account was showing us $3 because the bid ask, every time the transaction would click off, the bid ask would drop back down to like $3 because nobody was bidding on them. That's all. When they sold, they would sell for the regular price, but when somebody would bid on it, they would keep this really low bid. And you know why? Because they're trying to force people who don't understand options to think they've got a 60% loss and can kill the trade. They love doing that to you. Your ignorance is how they make money. So they take advantage of all these people have brokerage accounts and think and options. And this is, again, why a lot of people, they trade options. They go, oh, I always lose, blah, blah, blah. Yeah, you're going to lose if you don't understand what you're doing. All right, so Christy says, are you saying when you pick a price, you go to the last price paid and do a subtraction on the vertical based on those prices? Not necessarily. I mean, you've got, as a guideline, you want to look at the last price paid, but of course, obviously, there's a lot more weight to the last price paid if it was paid today. Like this one was at 11 o'clock, 620. Now, obviously, though, what do I want to do? I want to say, well, where was the NASDAQ at 11 o'clock? At 11 o'clock, it was over here. And where is the NASDAQ now? Well, it's in the same place. Therefore, this is still the right price. You got to use your head. You've got to understand the factors that go into play. If the price was 620 here at 11 o'clock, right? So here's 11, right here. Let's call this 620, right? Now, the NASDAQ goes up here. So I'm not going to get 620 anymore, am I? Because if the NASDAQ went back up, that means this would have gone back down. It's not down where it was when it was 464 on Monday. Where's Monday? So Monday at 490, it was way up here. So in fact, I have a pretty good guideline, right? So here's $6 and here's 460. So therefore, if I'm over here, it's going to be somewhere between $6 and 460, closer to 460. So I would expect to get maybe $5 if I was stuck over there. You got to use your head. You know, you've got data available to you. The trick is you've got to learn to understand how these things work and how they price. But it's always going to price on a bid ask. So there's like an auction, and if you're not the patient person, you will overpay at your auction. Or when you're selling, you will sell for too little at the auction because you're desperate and you panic. You've got to learn to be smarter than that. You know, and there are people, I mean, look, when there's an auction, there are people who are professional auction buyers and professional auction sellers. And they learn the same way we're learning. You have to learn how the system works and understand the process so that you can take advantage of the good prices. And if you do that, you're a winner. If you don't do that, you'll be a loser. End of story. How do you get your option chart to show on Thinkorswim? Okay, that's a very important thing. When you go to any option, you right-click on it, it brings up this menu, right? See there it says copy? So you copy the symbol, just click on it and copies it. Then you go over to the active trader chart, and you just punch in the symbol. I don't know what I copied, but whatever it was. And then you hit enter, and now it's going to bring up that symbol. And you can do with that symbol everything you can do with any other chart. It's going to show you all the stuff that makes it, well, that probably wasn't a, it has to be a symbol that's actively traded or it won't show anything. There's not enough data probably for it to come up. But it's going to show you that. Now, another cool thing, though, is if it's a really actively traded thing, let's go to Apple. Show you something really interesting, because you'll see the same kind of process as the active traded tab. So let's say the Apple January 105 is bound to be popular. All right, so let's right-click on it, go to copy it, go to the active trader, and we paste that in, and we hit enter. Now, you see what happens? Because it's got enough data, it brings up the whole kit and caboodle, even this thingy. So I can actually, right now, just like a futures contract, I can click on that and buy, or I can set my price. I can set a buy up here and click on it and say, well, if it gets to $6, I want to, well, obviously, if it's a contract. So if it gets to $6, I want to sell it, or if it gets to, oh, it's got, I'm doing 10 at a time, or 100, what is this? Wait. No, it's doing 10 at a time. You got to be careful about that also. Watch out for what the default is. But anyway, so in other words, if I want to say I'll buy these at 540, I just punch this in. What is this contract? I don't even know what it is. It's a 105 call. Okay. So for I'll do this for a second, but if I'll click on it, see it sets it up. So I'm buying 10 at 540. And you see how it's just like a futures contract. There's 2,700 people up there, or now 6,000 people here that are buying at these prices. So I'm not going to get my fill until all these guys get their fills. And you cancel it the same way, I hope. Oh, shit. Here it goes. Anyway. So that's how you do that. So you can treat active contracts the same way that you treat the futures. And you can get in and out of them the same way you get out of the futures and have the same charting ability. It's really nice, actually. Wayne says, Thinkorswim offers a place of bull call spread on an order. I find you'll always get better pricing doing the legs. Okay, but on the other hand, though, sometimes I say, oh, you know, if I can fill that for 50 cents, I would. But I'm not going to sit there and dick around with it because it's a silly thing. Like, let's say it's showing 75 cents, and I say, well, if that was 50 cents, I'd love it because maybe it's a $2 spread. And so I just put it in and say, oh, if I for random sake get a fill at 50 cents, I'll take it. If not, I won't take it. So I'll put one in like good to cancel at 50 cents, and it either fills or it doesn't. As a whole spread, I mean. Legging in, if I'm serious about something, it's a bigger position, I'll usually leg into it and do it manually because I want to make sure I get good prices. And again, you got to realize, you know, when you're talking about, you know, if one contract's $5 and one contract's like $8, I'm trying to do a spread. If I can save 50 cents on each side, that's $1 out of a $3 spread. That's, you know, that's a 33% improvement in my profit potential. So it's damn right it's worth the work, right? I mean, that's my job. My job is to get those prices. So yeah, you know, you really should practice doing that, and always, like, you know, and see, you'd be surprised what you can get. I'll tell you that the numbers that are up there on the bid ask are completely bullshit. They really are. There's so many of those prices are just completely off the wall. You should never pay those prices. Even the last numbers are bullshit sometimes. You just have to have your own idea of what you're willing to pay. So Chrissy says, can we look at the futures now? Well, these are the futures, Chrissy. Look, see? Which was this one? I forget. We got the Dow, we got the Russell, we got the NASDAQ, we're missing the S&P. There we go. So there's nothing to look at in the futures. I mean, we've executed a strong bounce. Strong bounce failed. We bounced back now. We came back to the weak bounce line, and the weak bounce held. So now we're trapped between the strong and the weak bounce. So now we're going to have what you call a triangle squeezy thingy. As a technical term, we have a triangle squeezy thingy, so it's going to go like this between these two positions until it resolves one way or the other. Now, tomorrow is Fed Day, so the chances are we're going to flatline kind of from this point forward into the Fed. We're going to more or less flatline, like bounce up and down between the strong and weak bounce. Don't know what the futures will do tomorrow. They might try to pump us up over the strong bounce line for the futures tomorrow. But in general, I think we're going to drift around this level into the Fed meeting tomorrow, and then it depends what the Fed says, whether they pop us or not. Now, of course, after the Fed, though, 2:30, you have Janet Yellen, and she'll move us also. But for now, barring any new news, any additional information coming in, which I haven't looked at the news recently, but you know, barring anything exciting happening, oh, someone said op trade disappeared. I didn't know about that. So barring anything special happening, we will see what happens on the bounces. That's all. This is not a good time to trade. We had an easy time trading, playing off our bottom and playing into the strong bounce. But now we have a much harder time because we don't know what's going to happen. Russia is, by the way, the biggest wild card in the world. You know, they're desperately trying to do anything they can to save their currency right now, and that could go either way. And isn't it December? They're like mowing my lawn. I don't know why they're mowing my lawn in December. I didn't even know the grass grows this time of year. So, oh, no, they're not mowing lawn. They're blowing leaves. That's what they're doing. It just sounds like they're mowing lawn. Anyway, so basically, I expect we're going to just do this. We're going to drift up and down like this. All these guys are going to soar tooth in, and that's, you know, that's how you get those triangle squeezy patterns. And they, you know, the ones that look like this, and then they're going to resolve up or down at the end of them, like this one. See, this one, you got this kind of pattern, and then all of a sudden shot up, but it was bogus, and then came back down. Now we're right back to the same place that pattern was. All right, but on the whole, I don't see a lot of strength to what's going on here. I really am not terribly impressed with the market. Let's take a look at a bigger picture. We'll see if I can fix this stuff, actually. Oops. Put you back where you belong. There you go. And we'll update the S&P. All right. You know, also, but you know, look where we are now. Also, that's another thing you got to look at. We're in between the 50-day moving average. We failed that 50-day moving average, and we're stuck now between the 50-day and the 200-day. And the chances are we're gonna keep going down this 1950 line. That's very, you know, without the Fed acting, we're very likely to just keep going down. And you see this is you see how you're only forming like one little negative dot here, and you just cross down here. This is not likely to suddenly turn up. Let's see where else we can show that. Well, see, you know, once these patterns turn negative, see, even though this thing goes up, you still had a drop in the S&P. It doesn't, you know, once these patterns start resolving to the downside, and you see this guy's going to cross red. Okay, see how these things come? He's a big thing here, and he starts going down. Then he comes down here, and the thing starts going down, right? So where are we now? This guy came down, and we're falling. So until until you have a little bit of a chance to go under the line, build up a little bit of momentum, and come back, you're not going to get it. So the chance of not testing the 200-day moving average at this point is very, very limited. Well, the oil inventory chart, well, I don't know what I can say to you about the oil inventory chart. I mean, it's just, it is what it is. Here it is, in fact. All this is the open interest. Each month you have a certain amount of barrels. So there's orders for 267,000 contracts. That's 267 million barrels, 188 million barrels. And when there's a lot of barrels, it means that the thing you have to accept is that they're all fake. Nobody actually wants these barrels to be delivered. If they were, imagine if they were delivered, because generally you've only got in any given month maybe 40 million barrels come out of Cushing, Oklahoma. That's where these contracts are for. So what if there was instead 140 million barrels in a month? Well, that means that every week there would be 25 million extra barrels in the inventory report. In the weekly inventory report, it'd be plus 25 million each week. Now that's not going to happen, is it? So therefore, you hopefully can understand that. They're fake orders. They're never going to get filled. It's all fake demand, fake orders. They're churning and churning these things. In fact, look at this. You've got 145,000 contracts that were sold 284,000 times in one session. That's how fake they are. They turn over 150% of the time in a day. It's complete nonsense. So maybe that's what you don't get, is you're trying to apply some logic to it. It's a completely fake market. But they're real contracts that have real legal effects. So should they be stuck with them, they'll have to accept the delivery of the oil, and that will then flood the market with tons of extra oil. That's the last thing these traders want. They're trying to keep the prices up, not down. So before the end of the contract cycle, which is going to be Monday on the January cycle, then these contracts need to be canceled for the most part, all but probably maybe 25,000 of them. So they've got to cancel 120,000 contracts in the next 5 sessions, and that means they've got to cancel about 22,000 contracts per session. So at this point, what we can do is we can start watching every day to see if they hit their 22,000 goal. And if they fall behind on their cancellation goals, then you know they're going to have a lot of selling pressure building up, and then you can expect a nice big down day. So that's all. All right, please elaborate on TF Russell, because that's the one we play or trade. Yeah, but again, there's really nothing to comment on here because now it's in a bad zone. It was easy for me to make a bullish call here. You know, when it was like 11:30, whatever time it was, I made the bullish call. It was easy to make a bullish call here because it was obvious. Here, it was easy for me to say stop because it was obvious. Here, it's in between the two. I don't play in between. You guys got to understand that. The reason I'm a good futures trader is because 90% of the time I look at these charts and I don't play. I don't see a good trade, so I'm not going to play it. I'm not going to call it. And I know you have to understand that futures are always there. They're there 24 hours a day, 7 days a week, except for like a little amount of time they're closed. You don't need to play it all the time. And you shouldn't want to play it all the time. You should wait for a very nice setup when everyone is lining up and they're all up. So what we had early was everybody lined up at the bases that we had predicted Thursday, which means they were following the rules we set out. They all came over here. See that green line, green line, green line, green line. So that was a no-brainer to call along. And they all went up. And what did I say when I called along? I said if any two of them fail the lines, get out. Well, they didn't, though. They all went up. So we had a nice signal that gave us a good reason to move up. You go long on the laggard. You see who's lagging? He's lagging. And he was lagging. Look how long he was lagging. He was lagging all the way till 10:50. And He was way down here at 9:30. And these guys are down here at 9:30. So, it's a matter of calling the pitches when you see them. But you can't swing at every pitch. They're not all good pitches. Can you explain your comment below? What the hell does that mean? Below what? And they say the poor sheeple. Well, what sheeple? I mean, to me, the people who were bullish on oil were idiots. I mean, how long have I been screaming that oil is overpriced? I have no pity for people who got killed on long oil bets. It's just ridiculous. It's just nobody checks their facts. There's too much oil. It was so obvious for the entire year that there was too much oil, that we were building inventories, and we had record high storage. And it wasn't just us. Other countries had record high storage. So you think, where does all this oil go? And the tankers were running out of. You were running out of tankers. So we had record storage levels in the U.S., record storage levels in Europe, record storage levels in China. And meanwhile, the tanker rates were going up because they were buying all the tankers and shoving the oil into tankers. So that's storage too. When you're shoving oil into the tankers and setting them adrift in the sea, that's also storage. But at a certain point, you run out of tankers, you run out of places to put the oil. And then you start seeing what we're seeing now. What we had last week, a 15 million barrel build? That's crazy. But there's just too much oil. There's too much oil and not enough demand. That's a pretty simple equation. The fact that it didn't work right away, you have to understand these like global macros. It's like, you know what it's like? It's like saying, it's like when I go skiing. I go skiing up in Lake Tahoe and it's like 21 feet of snow. And I can turn to you and say, if it's like February and there's 21 feet of snow, I say, you know what? We're going to come back here in July. There won't be any snow. And meanwhile, we come back in March and there's 23 feet. And then you say, what? You're an idiot. There's 23 feet. You said there'd be no snow by July. There's still going to be no snow by July. It just happened that there was an aberrant event in between. It doesn't change the macro. It doesn't change the fundamental that for a fact it's getting warmer. For a fact snow doesn't survive in warm weather. For a fact after X amount of months of warm weather, you can, even if it starts off like a cold spring, you can still be pretty damn sure that by July all 21 feet of snow are going to be gone. Those are macros. But you have to learn to play a macro game over a long period of time. Because you can be completely right and be completely wrong in the short run. And you have to be prepared to be completely wrong, which is why I always say you've got to scale into a position. You've got to take things slowly. You've got to set yourself up. You've got to be prepared to roll and to adjust your position. Because things can go against you, like Baker Hughes. We started the Baker Hughes position. We didn't take a big position. I forget what we took, but whatever we did take, it wasn't a big position. Where's our portfolios? Let's see how we're doing. See, look at our long-term portfolio. It was up 20% for a while. Now it's up 13%. I didn't lose faith in it. It's just at the moment we have some setbacks, but there's nothing wrong with it. Here you have the USO 2017 23 calls. Now we bought 25. We bought them for $15,000. It's not a big position for us because we have $50,000 blocks. It's actually a one-quarter position essentially for us. We expected to roll this down and double it down and change it. We're going to do that soon, actually. This is an entry position. We took a loss of $7,000 on our entry position because we were too early. Doesn't make it a bad play. I want to be very long on oil at $50 for 2 years. This is a placeholder. But you have to be playing the long game. What am I going to do? Stop it out? It was like, oh my God, it's down 50%. I'm not stopping it out. I'm buying more because it's only a one-quarter position. So out of $50,000, we're down $7,000. We're down 15% on the position, not 50% because the position's a $50,000 position. But what it does is it says, well, now we can buy more at 320, or we can roll and move to a better position. It's lower in strike, or we can change it into a bull Holster. We can do a lot of things now. I'm not sure oil is done going down. I think it is. Oh, really? Went back to, oh my God, it went back to 55. Well, maybe it's not been going down. So it already fell back to 55 off that little run it had. It's terrible. All right, so, you know, we don't know yet. We don't have enough information to make a change. We took this position a month ago and thought that 70 was, you know, we thought 65 was going to hold. It didn't. So now I'm not going to jump in and do something about it. We're going to wait and see. But eventually, I know I want to be long on oil. You know why? Because for a fact, I know that you can't sustain, the same way I knew that you couldn't sustain $105 oil, I know you can't sustain $55 oil, because eventually there's large blocks of people who shut down production. They can't afford to run their production long term. For a month, for 3 months, for 6 months, for 2 quarters, they can certainly afford to take a loss. But after a year, loans start coming due, and margins get called in on these people, and their hedges run out, and then they can't operate anymore. But I'm ready to wait that year. I'm ready to roll these to 2019. Because that's my position, because I have a long-term view, because I know snow melts. And this might be the coldest summer ever, and the snow may last until July, it may last until August, it may snow again before it even all melts. But you know what? We'll get them next year. Because that's the kind of position it is. Because the fundamentals are macro fundamentals, and they kick in eventually. But you can't try to outwit it. You can't say, I'm going to, you know, you're not smarter than that. It's going to kick in when it kicks in. You just want to be in the right place when it does. Can we comment on metal, specifically silver, and retail halting? Retail is halting online sales in Russia due to ruble fluctuations. Oh, that's interesting. Yeah, it's true. By the time they deliver it, it's like 20% off. That's funny. That's an interesting problem, isn't it? Because you really can't have online retail without steady currencies, because margins aren't good enough to support it. That is an interesting problem. Where are we? Oh yeah, so long-term portfolio down. It's still up. Obviously, it's still pretty good, but 565,000. But the key is now, if all's going well, the short-term portfolio should be balancing it out. So let's take a look at that. Yeah, look at 93%. So the short-term portfolio has $193,000. So what was the other one? 562. So 562 plus 193, 755. See, we're in the same damn place. It's very boring. We've been in that 745 range for a very long time, because we purposely balanced our portfolio so that one goes up when the other one goes down. You know, we did that on purpose. Now, we just changed it because we just cut down on our SQQs. We only have 50-50 now. We don't have the open ones. So we're taking a chance here at being a little more bullish. We got rid of those DXDs. We took the money and ran on the DXDs. That has leaned us. We are now less bearish on the short-term portfolio than we were this morning or last week. We're still bearish. You know, we still have 50 of these. That's a lot. We still have 50 of those TVAs. That one's bullish, the USOs. We have these Baidu puts, so they're coming back nicely. We have these EWJs. We have the FX. Oh, there's some FXIs. Look at that. See, we didn't do anything with it. Oh, $1.67. Wow, we really should. We should probably take those off. GMCR, that's useless. Well, actually, can make a little bit of a comeback. We're bearish on these fast. We don't care on Tesla. What is this? Yahoo puts. Okay, that's bullish. We're bullish on KBH. We're bearish on SQQ. Bearish on XRT. The fast were kind of bearish because it went too high on us. And the SLW, we're long. Yeah, so generally bearish, but nowhere near as bearish as we were. So if the market does another leg down, we need to get a little more aggressively bearish at this point. Aren't you bullish? I'm sorry, we're bullish on SQ2, but it's a bearish play. Yeah, I mean, you know, being bullish on SQ2 is bearish. So that's what I meant, that we're bearish. But much less so. I mean, we made two. See, there's another thing about balancing your portfolio. We took advantage of the dip earlier, and we got rid of two very large positions. We had 50 DXDs, and we had 50 of these SQQQs. We sold them, and that immediately tilts us a lot less bearish. So at what we think is a bouncy bottom, we tilted less bearish. And if the bottom, if we do bounce and we head back up, like if we do a big retrace, then we can then we'll have to see how we feel about it. But either the best thing is we won't be damaged as much by a retrace that we would have been. And which one did we sell? We sold the DXDs because the DXDs were our closest. They're Januaries, and since they're the closest negative that we had, so we didn't want to have a chance for it to go the other way on us. So it's all, you've got to look at all your different positions and pull, just pull one off and then pull another one off and see how it's working out. So obviously hitting 93,000. I mean, weren't we at like 70 yesterday? So we're up 23,000 bucks or something like that. So obviously, making $20,000 in a day or two is good. All right, so in a 5% move down in the market, this portfolio made 20,000 bucks. What do we do? By getting less bearish now, hopefully, if the market goes back, we're only going to give back 10,000 of it, not all 20,000. All right, and and again, why are we doing this? Because we're still pretty bearish, and we're worried about the Fed tomorrow because the Fed can be something really bullish, and all of a sudden the market can fly up, and we'll be so pissed off if we lose this 93% gain all at once just because we didn't have faith in the Fed. I mean, when does the Fed let us down so far? If the Fed does let us down and we start crashing, this thing's still pretty bearish, and it's very easy for us to add more to the spreads we already have. So that's where we are in that position. In the 25,000 portfolio, we also had the DXDs. We got rid of those. Now we're up. See, that had a great week because I think we were only up 15% last week. We're up 31% now. But that's because, again, we were too bearish. We were. And now it's paying off, but we were too bearish, and it was really killing us a couple of weeks ago. These BTUs are going to be dead, so I got to think about doing something about that. EWJ, I still think these can. I wanted to get half out for $1. We never hit $1. I think it hit 95 cents, so we missed it. GMCR, awful, terrible, big loss, and the USO, we're still bullish on that. So, and that's July. Doesn't take forever. And then we'll take a look at the butterflies, see how they're doing. They should be doing much better because we had a nice sell-off. Oh, 23. Holy cow. What a comeback. All right. So, and that's the thing. Last week, just a week ago, the butterfly portfolio was really hurting. I think it was down like 15% or something like that. It was at. So it came zooming back because just leave the damn things alone. I think that was my comment over and over in the butterfly portfolio to people last week. Everyone's like, oh, my God, because this thing's getting away from us and this thing's getting away from us. Like, no. We sell premium. Next week, we're going to sell more premium. The week after that, we're going to sell more premium. And eventually, we make money. Things don't go up forever. They don't go down forever. You just have to stick with the plan. And that goes back to the whole concept of the long-term strategy. It's like take a position, stick with your position based on good, solid fundamentals, and sell the short-term premium to other idiots. Don't be the idiot. You take the long-term position and sell the short-term because everybody thinks they're a genius and thinks they know what's going to happen between now and December. Like, well, who's that, Jow? Is that you? Is that with those USOs in January or whatever it was? It's like, I don't know what oil's going to do between now and January. I do know what oil's going to do between now and 2017. And that goes back to the snow melting thing, right? I can sit there with 20 feet of snow on the ground in January, and I can tell you that in July there will be no snow on the ground. I know that for a fact. Unless something changes, unless the global fundamental weather patterns change, I'm telling you that by July there will be pretty much no snow on the ground. Even after you're sitting there, when you're sitting with 20 feet of snow and you can't imagine how all the snow will ever melt. Right? I know because I have experience, because I've been there, because I checked the weather patterns, because I know the charts, because I've tried going there, and I've been to Lake Tahoe in July, and I know there's no snow when you get there. It's really amazing the difference between, winter and summer. So I know how this stuff works. It's a macro fundamental fact for me. So in January, I tell you that. Now, but I'm not going to bet you that there will be less than 20 feet of snow in March. And again, because I know that that's hard to predict, because you could get a big snowstorm in February. You could get a big snowstorm in March. And there could be 30 feet in March. And if I bet you $10,000 a foot, I don't want to lose $100,000 betting on snow. Not on a short-term bet. But if I own the snow puts for July, and you want to bet me that it'll be higher in March, then I'll take the bet. You know why? Because I know that I can roll your bet. And even if it does snow 10 more feet between now and March, I know that by July they'll still be gone, and I'll make my money. So I set up my bets with a time frame that lets me make an intelligent decision that backstops my other bets that I sell. And that's how you got to be with the options. And so they're always the same thing. I'm taking a position way out there in 2017 that says I think oil is going to be back around $70 by 2017. Meanwhile, as we settle into that position, I will be able to sell a $60 call. So in other words, let's say, just for argument's sake in USO. So at the moment we just took a stab at the USO. But what are we going to do? We have the USO, I forgot what they are, but were they 25s? Yeah. So we have these 25 calls. They're $3, right? So USO's at 21. So I want to be in the 20s. The 20s are $5. So I want to pay $2. That's easy. I'm definitely going to do that. So I want to pay $2 to roll down to the 20s. Now, I might want to get my $2 back by selling the 17s. So what's the chance the USO is going to go from 21 to 17? Well, 21 to 17 is $4. Okay? So 21 to 17 is $4. And yes, Chrissy, we are bullish on SQQ, but SQQ is a bearish play on NASDAQ. So that's why we said bearish. So $4 out of $20 is what, 25%? Is that right? 20%? Wait, no, sorry, 20%. So let's say it's 20%. So now, oil is currently at $55. 20% of $55 is $45. So if I sell the 17 puts, what am I betting? I'm betting oil doesn't go below $45. I frankly am not 100% confident in that bet. And I don't want to take the consequences of oil going to $20. It could happen. So I would rather stick with the limited loss of the spread we have now. So what am I going to do? So I'm going to roll. I'll spend $2 to roll to the 20s. And how are we going to get that $2 back? Well, we can get that $2 back by selling some smartass who thinks that oil is going to go up. So now I'm in the 20s. And look at that. We can sell the Oh, look at that. We can sell the $22 calls for 95 cents in January. We can sell the 23s for 50 cents. How much money do I need to make back? I want to make back my $2 I'm going to spend on the roll. Well, I can make $2 back by selling, and I've got 24 months to do it. So all I have to do is sell 20 cents 10 times. So look at that. Here's 20 cents. So I can sell the January 25 calls for 20 cents. And if I make that 20 cents, I've just cut 10% of the cost of my roll down. See, that's a very simple plan, right? I don't need to sell puts to offset my thing. I can sell some calls. And again, I'm not ready to do that. I'd rather wait until see if oil pops a little bit. But for now, our initial plan didn't work out. We paid whatever we paid to get into the $25 calls, I think $6. Now they're $3. We're going to pay $2 more to go down to the $20 calls. And I don't want to put more money into it, so I will want to sell something to offset that bet a little bit. And also, we're going to and I'll do the math. By the time we make the play, I'll figure it out. But at some point, I'm going to want to double down. So we'll have 2x at that price, and so if it's $6 plus $2 is $8 for the initial position, and now it's $5 in that position. Right, the 20s are $5. So if we double down, we'd have 5 plus 8. Which is, 13, 7 is 650. So I don't feel the need at this point to double down. I think I'm just happy doing the roll because our net cost is only going to be $8. We paid 6. We spent 2 more to roll down, so we're in this for $8. We have a $3 loss. We can work off a $3 loss, right? So we begin selling some calls to work off our $3 loss. End of story. So oil dropped 20% on us since we took the position, and we're in a very easy place where we can work this off. And that's all it is, because we have a long-term view, because we took a small position, we scaled in. 15,000 is small in a $500,000 portfolio, which is now a 600 and something thousand dollar portfolio. But so we have a $500,000 portfolio, we have $50,000 allocation blocks. We took 15%, I'm sorry, we took $15,000, that allocation block, and we put it into this trade. And it lost $7,000, but so what? It's not important, because it's only the very beginning of the trade. It had a bumpy start. Now we'll make adjustments. All right? So that's what I'm really trying to impart to people, is to get you to think in the long term and think of your trades as like an active, living thing that you're going to move over time. It's like, it's like you get in your car and you know where you want to go. You want to go east. Like where I live, I go east to go to New York City. I know where New York City is. I can see it half the time from where I am. So, I'm on a road, I can see the city. I can see the top of the skyscrapers. So I know which way I got to go. And I know which way I want to go to get there. I know what my goal is. I know how far it is. But you know what? The road curves. And sometimes the road curves so much that I'm heading the wrong way. Like it goes around a mountain, or it goes around some buildings or whatever, and it curves the wrong way. And I'm off track. But I know that if I stay with it and I keep on it and I make my adjustments and I turn my wheel, I'm going to get back on track, and eventually I'll get to my destination. All right? And when you take an option trade, like this USO trade in our long-term portfolio, and if you look at it and say, oh, we're down, where is it? All right. So, you look at this thing and say, oh, we're down 49%. Dead trade, horrible idea. Whoa, what were we thinking? That's not the case at all. We were thinking in November of, in fact, well, I'm not going to do it now, but I'm telling you, like on November 19th, I'll bet you my comment at the time was we're going to take a poke at oil at 630, because it seemed like a good idea at the time. And where's our charts? WTI. So what did we see on November 30th? Oh, here we go. We had this big spike down, and we figured this will hold. We were like, oh, 65, that's probably going to hold. And we got a big pop up, so we felt pretty smart for a few days and dribbled along here. But then, and boom, it started taking another leg down. But we took our initial entry here, which seemed like a line that was likely to hold. Didn't hold at all. And since then, it's gone down here. But we don't feel, but again, now the reason we were comfortable here getting in is because fundamentally, you can't sustain this. And that doesn't mean it can't go lower. It can go to 20, but it can't sustain it. Not for years. Eventually, $20, the supply of people go bankrupt. There you see, month after month, week after week, people start going bankrupt, producers. Then all of a sudden, you start having an oil shortage because not enough people are producing oil. Demand doesn't change. Demand doesn't go down. See, that's the other thing they don't understand about oil. Demand doesn't go up because oil is cheap. It's a bonus for me. I go to get gas. How low can oil go? Oil can go to 20. Oil can go to 10 because there's a glut. And until you work off the glut, it can go down and down and down. But it's how long it can stay down. And that's the thing. So that's why I'm saying I don't want to sell puts on USO because I don't know how low it could go. It can go 50% lower than it is now. So I sure as hell don't want to get stuck selling puts on it. But yeah, I don't know everything, unfortunately. I wish I did. But what I do know is, look, we've lived through this already. We've seen this happen. We just had this in 2009. Oh, and by the way, somebody was asking about silver and metals and stuff like that. We are now priced. Let's see if we can, I don't know if this thing goes to 2009. We'll see what happens. USO. So this happened in 2009. Oil, not oil, but USO was at 100 and something. Went all the way down to 25. And these are, let's see if I can get a better thing on a 5-year. Might give us a better look. Oh, shoot. Nope, that's not going to work. For some reason, it doesn't let me move the chart. Anyway, so these are probably months. So, so for like 1, 2, 3, 4, are these months or quarters? I think they're months. All right, so for like 3 months, 4 months, 5 months, it stays down here. But then, boom. Okay, there's demand. Something kicks it off. There's a little bit of a tick up. It doesn't take much to shoot it up. And that's, this midline here is like $40. So it goes from like 25 to 40 like a rocket. Then it drifts along here, goes back, goes up, whatever. So in other words, this is what I'm expecting to happen between now and 2017. I don't know how long it's going to stay down. And by the way, USO decays, so you can't go by this. It goes down. But the concept is it's going to find a floor somewhere, and I think this is probably where it's going to find a floor. But it's going to find a floor, maybe around 20. And then at some point, it'll kick up to like 25 or 30. That's all I want to happen. I don't know when. I don't know. In other words, I know where the right place is. So the right place is to have a position in USO at around this price. I don't know when the right time is going to be. But if I keep showing up at the right place, eventually it'll be the right time. And that's your opportunity. And how do I stay in the right place? I stay in the right place by rolling, by selling premium to other people who think they have their timing better than me. And I let them do it. I say, here, you want to pay me? Fine, I'll rent you my position. But I'm going to rent my position in such a way that I feel that even if it pops up, I'll be able to roll and deal with it that way. So that's how you play these things. But it goes back to the macro. So silver, somebody asked about silver. Silver, gold, same thing. We don't know how long they're going to stay down. Okay, but we're down at levels, and you can't. But again, USO decays, so you can't really prove it. But we're down at levels in the metals that are essentially showing us the 2009 levels. Now, don't forget the situation. See, this is the thing you got to go back to. You can't just look at charts. You got to think, close your eyes, and say, what was going on in early 2009 and the end of 2008? What was happening? Do you remember that people were basically telling us the world was going to end, that the financial system was going to collapse, that your money would be worthless, that you may have runs on the banks, that the third world countries would completely stop functioning, blah, blah, blah. So in other words, the world was ending in 2009. And these were the prices. As screwed up as things are in Russia and Europe and Asia right now, nobody thinks the world is going to end. We think we're in a recession, not a depression. We don't think currencies are collapsing other than Russia's. We don't think that all currencies are in free fall. We don't think manufacturing is stopped. We don't have millions of people out of work. When Bush was in office, there were 2 million people a month losing their job. Not 2 million, sorry, 1 million. 1 million people. But there was actually a month where 1 million people lost their jobs in 1 month. That's like 1% of the labor force got fired. So out of every 100 people in your workplace, one person got fired every month. Okay, that's bad. That was really bad unemployment. That was a really collapsing economy. That's what led to the prices that we have now. These prices don't make sense. Things are not that bad. And in fact, back then, I wrote an article saying how things aren't that bad because the global GDP, the entire global GDP is like $70 trillion. And the U.S. GDP is $20 trillion. So we're like a quarter of the global GDP. Europe is $20 trillion. They're a quarter of the global GDP. Asia, Japan, let's call Japan, let's call Asia, yeah. Japan, China, thing, you know, Hong Kong, Thailand, Singapore, all this, whatever, Thailand, South Korea, so on and so forth. So Asia is $20 trillion. So there are three major players. There's us, the Asian countries, China, Japan, and whoever, and Europe, and we're all most of the global GDP. Then there's billions of people who we're not counting, who are in, you know, African farmers and things like that, people in South America who we don't care about. You know, all those people are another quarter of the global GDP. Now, those people live on an average of $4,000 a day. And so do half of the people in our country. They are 4,000 a day. I mean, sorry, 4,000 a year. They live at like the bottom of the market. So of this entire planet of 7 billion people, there's like 1 billion of us who have enough money to trade stocks. Just 10%. And if we lose everything, if all of our money goes away, if everything we do is gone tomorrow, we still have to wake up and find food. And we still have to go from place to place. And we're still going to try to do our jobs and get paid and have commerce. So when you look at the $70 trillion global GDP and you think about it collapsing, it can only collapse to a subsistence level. And a subsistence level is basically $4,000 a year per person. So with 7 billion people on the planet, the bottom of the global GDP is about $30 trillion a year. That's if everyone on this planet lived like an African farmer. Then the global GDP would be $30 trillion instead of $70 trillion, so about 50% below where it is. That's what that's priced for. We had a 50% drop in the markets back in 2009. And that was pricing the global GDP to be at the level where everybody was going to be an African dirt farmer. It's just not going to happen. It's not realistic. We're not moving back to that kind of lifestyle in America. The people in Europe aren't moving back to that lifestyle in America. We invented electricity. We know how to power things. We have gasoline. You know, we have all these different things, you know, we have all these products and inventions. We're not going to give them up. Even if the economy collapses, we're still going to trade, you know, I'm still going to trade what I can do for iPhones. I'm still going to find ways to get stuff. I'm still going to find a guy who has sushi, and I'm still going to go out for sushi. Somehow or another, I'll trade. I'll get something. We'll barter. But that will still maintain the economy. So there's a level to how low things can go. And when things get so ridiculously priced, like metals are now, like iron ore is now, it's only because there's a temporary supply glut. Okay, it's not because there's too much iron ore in the world. It's not because there's too much gold or too much silver or whatever. Demand, supply, there are imbalances sometimes. But those imbalances don't last. Things revert to a mean. And that mean is more than $30 trillion. So the GDP of the planet now is $70 trillion. There are things that are priced like they were in 2009 when we thought the GDP was, well, I didn't think so because I wrote an article telling you how ridiculous that would be. But when things were being priced to a $35 trillion to $40 trillion GDP, that was never going to happen. The lowest the global GDP can go realistically is probably $50 trillion to $60 trillion. Only a 10 to 15% total reduction of where it is now. And that means that you can look historically at iron ore prices, metal prices, copper prices, so on and so forth, and say, you know what, over the long term, over 10 years, it's going to be around this price. So for copper, it's going to be around $3. For gold, it's going to be around $1,100, $1,200. For silver, it's going to be around $17. That's the price. If you look historically over time, you take inflation into account and so on and so forth, those are real prices. Same thing for coal, same thing for iron ore, unless consumption trends change permanently, like they have for oil, by the way. Consumption of oil is down and going lower. We are no longer consuming more oil each year, we're consuming less. We're moving away from oil as a fuel source. So oil will go down and stay down, but not so low that it can't be produced. So unless something changes that way, unless demand falls faster than we think it will, or unless supply comes up faster than we think it will, neither likely to happen, then oil is going to find an equilibrium point. The equilibrium point is not $100, though. It's more like 70. And if 70 is a baseline, that means it could easily be 20% lower than 70. 20% lower than 70 is 55. So when you're low in the channel that equalizes to 70, 55 is a perfectly realistic number. And that's where we are now with oil. And that doesn't mean it can't go lower than this, especially if people are panicking out of positions and it spikes lower. It can go lower, but the reality is the lower it goes, the more desirable it is. Because it's almost certainly going to go back to that channel. So the channel we trade, it's just like the big chart that we have for the stocks. Those channels, as you can see over the years, they're incredibly accurate. And the same thing as the channel for oil. And I told you when the oil was $105, I told you it was worth 70. And now it's at 55, I'm telling you it's worth 70. It's just like a goddamn pair of Levi's. That's what it's worth. 70 is a fair price. It doesn't mean it can't be 55. It doesn't mean it can't be 85. But it does mean that when it's at 85, I want to short it, and when it's at 55, I want to be long. And it could go to 100, and it could go to 40. But that just makes me want to go longer, and it makes me want to go shorter if it's on those ends of it. Just like with the market, I do the same thing, right? When it's way too low in a channel, I say we got to buy, and when it's way too high, I want to sell. Today, we got low in a channel, and we got to the bottom of that 5% channel that we were expecting, and we got less bullish. We got less bearish in our short-term portfolio. We take the money off the table. All right, and so here we are coming into, what is it now, 230? And we're still basically squeezing along. Like I said, we're going to flat line here probably into the Fed. So you're going to watch these lines, and tomorrow we're going to flat line into the Fed. So it'll be very exciting tomorrow, and we'll see what happens. All right, any other questions before I get done? Nope, everybody's happy? Good. I'm not going to do this next week because next week is Christmas and I got a whole bunch of crap going on. So we're not going to do it next week, but we'll probably do it the week of New Year's, all right? So, wait, what does the calendar look like? Let's take a look. Yeah, that's on New Year's Eve. So, okay, yeah, I'll do it Tuesday. Next week, no, because I got so much crap going on next week, I'm not going to deal with it. But on the 30th, we will do another seminar. All right, and I'll see you guys back in the chat room. All right, thanks for coming.